model number 1 plus. So in simple terms, you got a high, you stab into the old high with an up-close candle, and that is your entry level. No, it's not supply and demand. Supply and demand doesn't require you to stab into an old high, right? Nowhere in the book of supply and demand does it say you have to stab into an old high. It does say that you have to have a rally, right? And a rally does come from a key level, but it's not as precise. Nothing is as precise as this. And vice versa. You got an old low, you stab into the old low with a thick down close candle, explode above, and use that thick down close candle to rally again. This is also a range, by the way, right? Range low, range high. You wait for this to form, add the range low, range high. Everything's connected. Everything you learn and everything I teach you is connected, and there is not one single contradiction. And this is a challenge for the skeptics as well. In the concepts, everything is complementary, right? Nothing is contradictory. That's a bold claim, but it's true, right? And if you don't believe that, then verify. Again, over here, you have a higher time frame key level. This is the full picture, by the way. So a simplistic view is this: high, in the most basic terms. If I was to trade one model as a pattern, it would be this. All right, so for the simple minds, those of you who don't want to complicate their lives too much, right? This one is for you. High, stab into the high with an up-close candle, close below it. As soon as you close below this candle, you got to sell. All right, is that simple? And vice versa. You got an old low, you stab into it with a down close candle. As soon as you close above the candle, you got to buy. If out of all these videos you take this away, then you've done a good job, right? For the most lazy of the lazy. And now for the rest of you who want to go and look deeper, it's always going to stab into the old high after the opening price of the new candle. There's always going to be a higher time frame key level that leads to the expansion, right? And multiple highs are better than one high, and the highs from the previous candle are better than the current highs, and vice versa, right? Key level, stab into the key level, and before you hit the key level, there's always a range, and there's usually a market structure shift. Don't always bet on this, but there's always a range, right? A higher time frame key level, lower time frame range, stab into it, order block, rally. Order block, the thick down close candle that stabbed into the old low. Here's a chart example. Thick up close candle that liquidated an old high. High, low, old high, thick, heavy, high volume, up close candle. As soon as you close below this, right, you can look here as a point of interest to sell. And then, of course, you can sell a continuation over here. And vice versa. You have a low. You stab into the old low with a thick down close candle, a red candle, right? This one specific candle is the candle that causes the rally. This one specific candle is the candle that causes the dump, right? This one specific candle is the one that causes the rally. Close above, confirmed. Stop loss below the candle, or above the candle, and target the old highs. Yes, that's a wide stop loss, and yes, there are ways to refine it, obviously. Such as the high that formed, the swing high that formed into this key level is a stop loss, and vice versa. Moving on, how to trade model number one. Mark the opening price, wait for price to print a thick up-close candle into an old high, or a thick down-close candle into an old low. Wait for them to close above the down-close candle or below the up-close candle. Enter at the specific candle's high or low in the direction of the higher time frame order flow as everything. All right. So here, for example, down close candle that goes into an old low, close above higher prices. Down close candle over here, this one specific candle. It's always one specific. It's not a zone. It's not an estimated area. It's not a guesstimation. It's one specific concrete candle. Over here, use this one candle to rally, and vice versa. All right. This thick up close candle is stabbing into these old highs. When you close below it, it's the key level that causes the rally. This one candle is causing the rally. This one candle is causing the rally. This one candle is causing the rally. And here's a note on how to backtest. First of all, you check where it works, right? Because you might say that, for example, you can't. Downwards candle. Let's look at an example that failed. I'm trying to. Old high, up close candle, dump. Right. Let's just say that it fails sometimes, right? That doesn't matter. The point is that you first have to accommodate yourself to seeing what it looks like when it succeeds in backtesting. That's step one, right? And then you try it out live, right? The specific times that it worked correctly, you mark that out. And you try it in real time. It'll work most of the time, and sometimes it'll fail. That's when you study the failures, right? But when you backtest, then you have to have some sort of bias to the idea, because you're trying to accommodate yourself to what it looks like first, right? Of course, you will fail sometimes. That's inevitable. Yes, even I get it wrong. Sometimes that's quite rare, but it happens, right? But first, get used to the right thing. If you don't know what the right thing is, then how can you determine what the wrong thing is? Right? So in summary, all that rant, backtest when it works 1,000 times. And then try it live. If it works, great. Mark everything. More on journaling in the next chapter. If it doesn't work, then mark why it didn't work. It's that simple. Right, again, high, low, higher, high, lower, low, turtle soup. Remember? And this one specific candle is the one used to rally. The pattern, model number one, will occur with the order block being created, stabbing into a previous candle's high, or a range being created with the order block stabbing into the current candle's range, high or low. First case, the order block being created, stabbing into a previous candle's high, such as here, or low, right? You have the previous candle's low being stabbed into and closed above. Previous candle low, stab. One specific candle causes the rally. Previous candle's high, stab into it, close below, confirm. One specific candle causes the dump. or it can be within the same candle, right? Like you got it. You have an example over here. High, up close candle stabbing into the high, close below, and you can see that they used it to dump, right? So it's either going to be an old low of a previous candle, right? Open, power of 3. Everything feeds back in the power of 3. Open, dump, old low, when the higher timer is bullish, then you get a rally, right? And this is model 1, below the open. You're bullish, wait for the open, you wait for a range to form, and then model 1 to form within that range, and rally, right? Below the open again. When you're bullish, you buy below the open. You look for the pattern below the open, and vice versa. Entry trigger. Close below the candle that liquidated the higher low. No trigger, no entry, right? You have strict rules to your model. It tells you when to stay out, and it tells you when to participate, right? If there is no close, you have no trade. High probability times for intraday, because a lot of you are a fan of scalping, and short-term daily range trading are 3 to 5 a.m. and 9 to 11 a.m. on the 15 and 5-minute time frame. Finally, and this has been a long, interesting lesson, a quick buck model. In the most simple terms, trade the candle after the candle that hits the key level. Because the candle, and focus with me here, right? Hopefully you've been focused during the entire thing, because not a single word was out of place. Everything is deliberate, nothing is random, right? So focus. And if you weren't focusing, watch it again, and again, and again, with a notepad and pen in hand. You need to be writing down everything. Your thoughts, what I'm saying, the summary of what I'm saying, what your questions are, what's your doubts, everything written down in paper, right? There's a saying which is, knowledge is a prey and writing is the net. Secure and catch your prey with thick nets, thick ropes. It's an Arabic saying. العلم صيد والكتابة قيده قيد صيودك بالحبال الواثقة. Right? So write down the important stuff. Trade the candle after the candle that hits the key level. If bullish key level, buy below the open of the next candle, right? If bearish key level, then sell above the open of the next candle. This model is basically trying to catch the ICT classic buy or sell template, right? And I didn't call it the classic candle on purpose, because there's many ways to catch the ICT buy and sell template, right? One of them is this. What the essence of the ICT buy or sell template is that when bullish, in an ideal scenario, you buy below the open, they open, you get one trade here, trade number 2, trade number 3, a classic buy candle. Or you get a classic sell candle, right? Open, rally, sell, decline. How do you catch this? Because if you can catch 4 of these a month only with high accuracy, then that's all you need. That's 4 days of work, the entire month. Right, but how do you catch them? By trading the candle, and this is one of the ways, by trading the candle that, not the one that hits the key level, because that one's usually a choppy candle, right? The one after the one that hits the key level. So you see chop, chop, chop. Everyone's complaining about the markets being volatile and choppy, right? Everyone's losing. And then you get one smooth candle, right? And this is what everyone's trying to find out. This model is a basic method of how to find it. There are more advanced techniques on how to identify this to the pip, right? And know exactly when, where, and how they're going to happen. What does that mean? That means I'm telling you that there's methods out there which allow you to know exactly when this happens. Open, rally, dump. Or open, dump, rally. That's a more advanced topic for later, but the most basic way to achieve this is through what I'm showing right now. A visual representation. You got candle 1, candle 2. Key level is hidden in this one, right? And the most volatile and easy to trade candle out of all of these, I'm sure you can agree, is this one. Right? Also has a model number 1, by the way. Right? Old high, thick candle, close below, dump. This one specific candle is responsible for this entire dump because it happened at a key level. Right? Important high, a quick revision, right? High, lower low, higher high, break, bullish, right? Bullish. First sign of bearishness, second sign, and dump. OTE buyers all wrecked. Right. Again, you mark the FVG, right? This candle touches the FVG, your key level, and the next candle is a classic sell. Close below, right? Key level, assuming there's an old high, and there is, and this is a chart you should be familiar with. It's a higher time frame, important asset chart, excuse me. Candle number 1, chop, and the candle after the one that touched the key level is a smooth sailing. Right, so in summary, trade the candle after the candle that hits the key level. This allows you also to confirm the key level because the structure on the lower time frame that you see on the candle hitting the key level will reveal the intention of the candle after that one. Right. As always, if it's a bullish key level, buy below the open of the next candle. If it's a bullish key level, then you simply open, sell, dump. Excuse me, open, rally, sell, dump. Right? And remember, everything feeds into the power of 3. Everything you ever study, ICT, Turtle Soup, SMC, it must feed back, even the details, right? When I give you details, like for example, by looking at this chart, you already know the candles are ranges, and this one range has been turtle souped into a key level, and is the second candle after touching the key level. So you expect smooth sailing, right? Now, I'm aware that some of this may be too advanced for some of you. And if that's the case, then go back to the old stuff. Go back to the previous lessons. Look into your charts. If you don't understand something, it's your fault. Because you haven't looked at it deep enough. You haven't seen it enough times. If you're confused about a concept, then you simply haven't experimented enough. Right? It's always your fault. If you lose, it's your fault. If you win, it's your fault. If you understand, it's your fault. If you suck, it's your fault. If you lack mental ability, that's your fault. You can fix that. Whatever state you're in right now is your fault. Right? If all of this is smooth sailing and you really found this eye-opening, well, it's your fault. It wouldn't be a fault in that case because a fault is a negative thing, but it's due to you, right? Thanks to you, it happened. Obviously, I am facilitating this to you, right? I'm making it easier. I'm giving you advanced tools to go and potentially extract money from the markets, but the application is on you. Right, so just a side note, addressing those who might find this complicated. It's supposed to be complicated, and you're supposed to go and experiment and try once, twice, 10 times, 100 times, 1,000 times, and eventually you'll get it, right? So, power of three. Open key level rally, open SMT rally, open range rally, right? That's all you'll ever see. This is the lens through which you see the charts. Model 1 here, right? But Model 1 came following power of three, right? Power of three doesn't happen because of model number one, right? Model number one happens because of power of three. And this has been a long lecture. My voice is getting raspy. My throat is hurting. It's been hurting for a while, but I'll keep going, right? The common denominator in all of the trades you've seen me take, in any successful trade you ever see, right? If you see someone trading Elliott waves successfully, then he's trading the power of three without knowing it, right? Everything boils down to the power of three. If you trade a breaker successfully, then you're trading the power of three. If you trade market structure successfully, and yes, they exist, then you're trading power of three. Whatever you trade, if it works, it worked because of the power of three. SMT, power of three. Key level, power of three. Range, power of three, right? A range is literally it's the embodiment of the power of three, right? Accumulation, manipulation, distribution, right? So everything has to feed back into this, whatever you study. And it's the most simplistic summary of the markets. This is ICT in summary. Open, key level, rally. When you're bullish, open, dump, rally. When you're bearish, reverse this. Open, rally, dump. So it's going to keep dumping lower. It's going to stop at the key level and rally. It's going to keep dumping lower. It's going to stop at an SMT and rally. It's going to keep dumping lower. It's going to stop. It's going to range and then rally. Right? And each one has its own entry methods. And more in depth on entry techniques in the next chapter. Right? So everything feeds back into the power of three. All of it. It's always going to be a candle opening, previous high, declining. Now, you can go crazy chasing and pattern trading power of three, obviously, right? You'd need to be really stupid to do that, right? But it's possible. So always bear in mind the higher time frame, draw liquidity. That will help you trade the important candles. And that concludes this lesson. It was heavy and dense, and I suspect for some of you, it's going to be the most fun one, right? Because I dropped some things which I hadn't spoken about before, neither in public nor in private. So enjoy. I hope you found it insightful. I wish you good luck, good trading, and see you in the next one.